Hello, hello, and welcome to the fourth quarter of 2025 market review. It is January of 2026, and my name is Austin Fitch here at Horizon Investments. We're excited to jump right into a new year and review a little bit what happened in 2025, but hopefully spend a lot of time looking out into 2026. As always, I'm joined here today by our CIO, Scott Ladner, and really excited to get into the conversation. I think Scott even has a cup of our newly minted cold brew in hand. For anybody that hasn't been to the office, we had a cold brew machine installed about a month or so ago now. It's been a big hit in the office, but I would invite anybody that is out there that hasn't been to the office, come visit. We'd love to have you. We'd love to host advisors in the office. We try to have folks in almost every month. So again, reach out to your regional director, reach out to your strategist. But again, we'd love to see you in 2026. With that being said, though, we will jump in to the agenda for today. And as you can see, we're going to talk about maybe some themes that we've talked a lot about over the last year and a half, 2 years at this point, focused on kind of that AI theme. But we're going to look through it today with a slightly different lens, right? We've been talking a lot about just kind of the AI theme at a high level. Now we're going to really start to dive into, okay, what does that mean as it starts to diffuse through the economy? What does that mean for the labor market? What does that mean for interest rates or productivity? A lot of those things are things that we're going to try to hit on today and really put some meat on the bones as to what this AI theme could mean for the markets broadly, but also for the economy as we start to think about the next few years and what that looks like. So without any further ado, we will jump right in. And like I said, we're going to start kind of at a higher level talking about the economy. And as we're talking about this AI kind of theme to begin with, Scott, let's look at just from a scale standpoint and a comparison standpoint, other booms that we've lived through or we've seen take place here in the US and how this kind of AI theme plus some of the other investment and CapEx conversation that we've had really starts to flow through.
Yeah. Hey, Austin, and hey, everybody. Look, put this up here just try to get some get some context and understand like what are we really talking about, because we'd be talking about some AI, about CapEx, about some of these other things, as Austin alluded to. But just like I don't think people necessarily always appreciate the scale that we're really dealing with here, because by the time we're done with the sort of the AI thing over the next few years, and it's not really done, but like really sort of the build part of it over the next year or two, it's likely going to eclipse everything except for what we did against the pandemic, from a sort of a response or kind of infrastructure build kind of stimulus type of package. And so just want to kind of set the stage for like this is a big deal. The reason why we're talking about it is because like this is the kind of scale that can drive an economy and can drive markets for multiple years, which is what we've seen already and what we think we're going to see for the next couple as well.
Awesome. No, I think that's a great place to set the stage. And Scott, another thing that we've talked a lot about in recent quarters is just the financial health of the economy. And this chart, I think, does a really good job of just highlighting the fact that the corporate sector, if you actually look at debt service ratio, right? Corporations' ability to pay off and service their debt. We're sitting here at really multi-decade lows going back to the year 2000. You can see that coming out of the Great Recession there in 2008, 2009, we hit similar levels as what we're seeing today. But this, I think, paints a pretty good picture of where we sit from a financial health standpoint, which then, Scott, if we look at some of the additional data, actually flows through into maybe a run that we think is actually fairly sustainable.
Yeah, it is. And look, part of the reason why we showed that chart before is to give the idea that if we do need to actually transition to a more of a debt, basically using debt to finance some of this spending, there's plenty of room. There's plenty of room to grow corporate balance sheets from here from a debt standpoint. We're very under leveraged currently on the corporate side of the world. But this is I think a fairly powerful chart just showing like the spending that we've done thus far, and which has been substantial with respect to the CapEx things and with building AI, is coming from free cash flow. This is not, we're not borrowing money like we did in the internet boom to basically build the routers and build the fiber optics and all the stuff that had to do with building out sort of the capability to diffuse internet capabilities throughout the economy. This is being financed, but basically by the largest companies in the world, through their own cash flows. And that makes it much more sustainable, much safer. It's a much safer capex build than we got at the end of the 20th century. And so, again, just for not sure people appreciate that fact, but that is, this is like a safe and sustainable way to build capex, and we're kind of excited to watch it.
Awesome. No, and I think kind of to your point about this build out really just beginning, Scott, a lot of times we get the question, hey, okay, so what inning are we in, right? They use the classic baseball reference, like, if there are 9 innings in the game, or are we in the second inning? Or are we in the seventh inning, right? Are we near the beginning or the end? And I think this chart actually does a really good job looking at different investment cycles over kind of capex capital build outs, right? You're looking at oil and gas, you're looking at telecom, you're looking at railroads, you're looking at post World War II auto manufacturing. Like all of these are on this chart, and you can kind of see the similarities of what we're starting to see in this AI build out, Scott. And I think what we see here is we're probably still on the front end of that what inning conversation. 2, 3, maybe you can make the case that we're getting into the fourth inning at some point in 2026. But Scott, is there anything that you've seen that would suggest, later or earlier? Like, what's the thought process there from an investment standpoint?
Well, look, I mean, I think it's important to understand that, these, like all the examples here are physical build outs of stuff. And so, yes, things happen more quickly now than they did 100 years ago. Like you do build things a little bit quicker now than used to, but it's not like we're an order of magnitude faster. And so, I do think that sort of the time scale for this type of analysis is actually useful and relevant, and does give us a sort of a guide as how to think about like how much further we have to go to we sort of reach, peak build. And it probably is another year or two to reach peak build, and then probably taper off from there. But this is, Austin, as you said earlier, we're probably bottom of third here.
Awesome. No, that's super helpful, Scott. Is again, a lot of folks are getting the conversation because we've been talking about AI, both at Horizon, but broadly for a couple years now. So the question becomes like, where do we stand? I think this picture gives you a pretty good kind of just sense of where we sit, which then, Scott, that kind of segues into this idea of, okay, so how is this being funded, right? We talked a little bit about, corporate health and financial health. I think, and this one is one that it's a little bit nuanced, but I think as you start to get into those commercial and industrial loan credit lines, you get a sense of like, hey, where is this coming from, and where does that look like we're going, right?
Yeah, and look, and the reason why I'm putting something like this up, the sluice is loose. Like the sluice, was a big deal a couple of years ago, and we've been looking at it for a long, long time here. But to remind everybody, this is the senior credit loan officer survey. And so this is just this is just like basically polling bank lenders and saying, are you more or less willing to make a loan? And when that magic green bar is green, that means that people basically bankers want to make loans. When it's deep red, that means they don't want to make loans. And so this is kind of like the willingness to supply loans to the corporate sector. This is important. That the fact that it's turning, it's about to turn positive here for the first time, and really like about 4 years, really since COVID kind of hit. It was it's important because AI is not the only kind of capex we got going on. We do have the big beautiful bill, and that's sort of like all we talked about last quarter. We have to build a lot of stuff here. Like structures are old, the infrastructure is old. We have a big infrastructure project building, like basically build out that's going to happen in this country over the next 5 years, essentially. And this is important. This type of information is important because it shows that to the extent that folks in the companies want to borrow money, which we think that they're going to want to, and they're basically being incentivized to do so through the provisions of the big beautiful bill. Banks are going to be willing to loan it. And so you kind of have, it does to sort of take two to tango when we're talking about loans. Like, got to be willing to borrow, you got to be willing to lend, and it looks like both those things are coming together right now with the proper incentive structure policy in place to make it sort of the capex build not only for AI stuff but for everything infrastructure related, really, or sort of manufacturing equipment related. Really a pretty big deal and a driving force in the economy, not only in 26, probably in 27 also.
So, Scott, if we talk about kind of those intentions that you're talking about, then the question becomes, okay, does that actually, like, is there history that would suggest that actually turns into anything? I think the data here would show that historically, that's a pretty good kind of forecasting mechanism for what we should expect.
Yeah, look, I mean, a lot of the time you want to see bank credit running above nominal GDP. That's a sign of sort of the fractional reserve system working, money credit creation working to expand the economy, sort of leveraging the system, kind of working in a healthy way. Not extreme amounts, but you do want to see it running above. And since essentially Reagan, like that's kind of what you've seen in the in the economy outside of a couple of periods of time that we highlighted here. And importantly, the thing I want to draw everybody's attention to is that the most recent data point that we just got is showing that we finally, for the first time again, really since the sort of the COVID weirdness has really sort of taken hold, we are starting to get loans, basically loans and leases out of commercial banks. And we're starting, the loan machine, the credit creation machine is actually starting to work. So you have, the last slide was like credit intentions, like, or do we want to loan money? And this one is like, yeah, we're actually loaning it. It's actually starting to work again. And this is a very healthy sign for a normal, an economy that continues to normalize and continues to heal from the COVID weirdness. But this is exactly what you want to see coming into the beginning of the year.
No, I think that makes a ton of sense. And if you talk about what we want to see, I think another piece that we have to hit on, and we've talked a little bit about in previous quarters, is this concept of productivity, right, Scott? And as we're talking about CapEx, as we're talking about AI, it's really a question of, how does that increase productivity across the economy? And I think this chart right here does a really good job of showing us some of that productivity growth. It's really started to pick up in recent years, getting back to levels that essentially are kind of multi-decade highs going back to the mid 1980s. So if you look at that productivity piece, right, you're seeing productivity growth pushing 4%, which again, doesn't happen all that much, but when it does is really when you should expect to see kind of that flow through to the economy. And Scott, I think if we look at some comparisons, this goes back to what we were showing earlier, some of those investment booms, like you start to see those boom years come when you get that labor productivity growth that we're starting to see here recently, which is very different than I think what we all lived through in the 2010s, for example, when productivity just kind of spun its wheels. You're seeing a lot more productivity growth over the last couple of years, and we'd expect this probably to continue to increase based on that chart that we just looked at. And if that's the case, then you're looking at some of those boom scenarios where it's the 1960s or the 90s into the 2000s, where you're seeing productivity gains that are really meaningful from an economy standpoint. Scott, anything else that you would add there as we start to think about productivity and what that means?
I mean, look, like this is the Roaring '20s, and this is if we get productivity gains like we got in the '90s, like we got out of automation in the '60s, we get something approaching 3% again in the 2020s, it is going to be a good time. I mean, like this is the magic elixir for an economy is to get productivity gains, and you get them. I mean, I've said it a bunch of times. You get it about once a generation if you're lucky. We are the front end of one right now. It's catch on.
Yeah, and I think we've shown a chart similar to this in the past, Scott, I know, but productivity gains, what does that mean, right? How does it transfer? Well, it hopefully transfers into profitability, right?
Yeah, I mean, like this is where the rubber meets the road for, like what does it actually mean to get productivity gains? Like, what does it mean for firms? What does it mean for companies? What does it mean for earnings? It is just, productivity is just doing more with less. And like you're seeing output grow while kind of hours worked stay about the same. Like that is definitionally what productivity looks like. And guess what? That does to margins. We'll talk about this more in the equity section, but like this is the best case scenario for companies, for corporations, for profitability, for corporate profits, therefore employment, like the whole logic chain. This is a big deal, and this is what it looks like in pictures.
No, that makes a ton of sense, Scott. So, all right, we've talked about productivity. We've talked about CapEx and kind of some of that AI theme. One thing that we haven't talked a lot about, Scott, in really since this most recent administration took hold, I guess a little over a year ago now, is you're starting to talk a little bit more about deregulation, which I think a lot of folks expected us to be talking about, given what we saw in the first Trump administration. Now we're finally talking about it kind of in this second Trump administration. So let's unpack what that means and maybe why it took a little bit longer this time, but then also what the effects could be.
Yeah, I mean, again, another way to get sort of productivity enhancements or kind of supply side effects in an economy is to reduce red tape. Reduce regulations, and the deregulatory push that frankly I also thought we were going to get it pretty early in the second Trump administration, just based on history, what he did the first time. It was a big push in the first year of Trump 1. It was basically a zero push in year 1 of Trump 2 because frankly other things took priority in his in sort of the pecking order for him. I mean, he cared a lot more about tariffs. He cared a lot more about the big beautiful bill sort of passage. and didn't really seem to give a whit about deregulation. It just took a back seat. But now Big Beautiful Bill is done. Tariffs, we sort of kind of know what the game is there at this point. And so that we do think, especially as you come into very very thin margins of majorities in both houses. Deregulation is something that can be done with the stroke of a pen, and Trump is the kind of guy that likes to do that type of thing. So we would expect to see a deregulatory push in 2026 and beyond, and this is more sort of supply side types of things that could be helpful. Should be a tailwind in 2026, especially for firms like financials.
All right. So if we have, deregulation, if we have CapEx, if we have productivity gains, that's a lot of kind of tailwinds for us to be thinking about. But Scott, I think it is fair we gotta make sure we hit on some of the headwinds, right? And one thing we are starting to see, and we just want to make sure we're highlighting both sides of the equation here. We are starting to see a rising unemployment number, and that's something that we're keeping a close eye on because, again, labor market is extremely important as we start to think about what that means for the broader economy and consumers and spending. So Scott, we have seen for the past, I don't know, a couple of years at this point, probably, the unemployment rate continuing to tick up. We haven't seen any massive spikes like maybe you have seen historically heading into a recessionary environment. But the fact is that you are seeing it tick up. Is there anything that we should make of that as we currently sit from an employment standpoint?
Well, look, I mean, it's this is a somewhat important and like a little bit nuanced chart because if you look at the times that unemployment rises, it doesn't tend to grind wider, doesn't tend to grind higher, it tends to leap higher. And so, the reason why things like, you guys might have heard of the SOM rule. The reason why something like that works historically, did not work this time. The reason why it worked historically is because, kind of once you pass a certain threshold of unemployment, call them gains, it's just like unemployment going higher, going the wrong way. It just sort of reaccelerates. It sort of accelerates itself, and there's a bit of feedback mechanism associated with that. That's not what we're getting out of this labor cycle, out of this sort of very gradual rise in the unemployment rate. As we'll see on the next chart, Austin, this is the slowest rise of unemployment that we've seen. I mean, again, typically when you get the unemployment rate kind of starting to move, it starts to move. And this one is just like we're just sort of grinding a little bit wider. But again, it is important, and you've heard us say this a zillion times on these webinars over the last couple of years. The starting place matters. And the starting place for this unemployment rate was it's like a 75-year low in unemployment rate, and we're grinding a little bit wider. It is worse. It's 1 percentage point higher now than it was where it was about almost 3 years ago. But it's not really the worrisome part. We're watching it. I mean, this is not it's not a zero concern for us. But it is right now not a very high concern either.
So Scott, it says it in the title. But shouldn't we have to worry that AI is going to kill these jobs, and then you're going to see the spike, right? Is that the problem? Is that what we're worried about?
It's certainly one of them. But as our Indiana-clad Corsair friends, would like to say, it's not so fast. Look, this is the standard kind of worry out there in the labor market is that AI is going to take all the jobs. There's going to be nothing for anybody else to do. It's going to take all of our jobs. Robots going to replace us. Yeah, sure, okay. It is not bearing out in the data thus far. So what these bar charts show is that basically jobs that have a high touch point or high sort of exposure to AI are doing better. They're doing better with in terms of annualized job, growth rate of jobs, and also meaningfully better on the wage side. So you're getting paid more and there are more jobs. In professions and jobs that are associated with AI rather than ones that are not. I'm not saying this is going to stand around forever, but thus far we are not seeing any impact on the writ large scale and sort of the national scale of AI to destroying and taking all the jobs. Now, let me be really clear: we want AI to destroy jobs. If AI is not destroying jobs, it is not being sort of transformative in terms of the productivity enhancing engine. We want the creative destruction out of AI. We want it to destroy some jobs, because what happens every single time in history is that when jobs get destroyed by a transformative technology that enhances productivity, is better jobs come along to replace it. And I don't have the foggiest idea, Austin, what those jobs are going to look like. It doesn't, just because I don't know what they're going to look like, though, doesn't mean they're not going to exist. Because it's just, there's a bit of trust that gets involved here, and just trusting that the system will end up working and that the new jobs will get created and they're better than the old jobs. I just don't know. I just not smart enough to know what they look like yet.
Yeah. No, I think that's a great point, Scott. And I flipped ahead to this chart because I think what we've seen even historically is you have some of those kind of technology type revolutions, or you have CapEx investment that really starts to take hold, like things that we just talked about. It does take a little time for that to flow through into the employment market before you actually start to get maybe a more meaningful employment shift. You can see it whether it's the early 90s, the early 2000s, or post Great Recession. You had these CapEx kind of investments really flow in, and then call it 2-3 years later, you really started to see the employment picture kind of improve. And I think, Scott, that's kind of some of what you're saying is we're seeing that CapEx push right now. We've heard a lot about AI destroying jobs, and to your point, we probably will see that at some point in the next year or two.
We better.
But down the road, what you're expecting is then employment to pick back up because of that CapEx investment, because of the productivity gains, maybe creating jobs, Scott, to your point, that don't even exist today.
Yeah,
right?
I mean, look, I mean, real simple, guys. Like CapEx is the fertilizer for job growth. It takes a couple of years, we've all seen what's happened with CapEx over the last year or two here in the United States. It's not just the United States, by the way; it's globally. And it's like the jobs they don't appear overnight. I mean, this is not the magic beanstalk stuff. This is this takes a little bit of time to get going, but once it gets going, it is a powerful engine, and we're right on the leading edge of it.
Yeah. And so, Scott, we talk about kind of that employment side of, hey, we're teetering on the edge of maybe a little bit of concern when it comes to the employment picture. I think this chart does a really good job of saying, okay, but maybe here's a reason that you're really not seeing employment concerns, because corporations are just killing it, right?
Yeah, I mean, like you know what you don't do when you have all-time high profits that are growing, you don't fire people. You don't rock the boat. When things are going well, you don't like mass fire lots and lots of folks like all at the same time and create unemployment. Like that's just so yes, like another sort of employment buffer that we've got going on right now is this well documented just corporate earnings surge that we've had over the last 3 years, and that is a very meaningful like the kind of buffer against higher unemployment rates.
Would it be fair to say, Scott, that this is something that we're watching pretty closely? If for some reason you started to see earnings roll over, that would be obviously a concern for the employment picture.
It would put the labor market under a lot more stress, and yes, it would be a high concern really quickly.
Got it. Okay. All right. So last thing on kind of the employment side of things is let's go into kind of small businesses, right? And I think one thing that we've really started to see pick back up comes from the National Federation of Independent Businesses. Basically, they do a survey and looks at hiring, plans, and you've actually seen that tick back up. And I think, Scott, a lot of what we're seeing there is uncertainty, as we've talked about time and time again. Markets hate it. The economy broadly hates uncertainty. You're starting to see some of that uncertainty fade with Liberation Day, what that means for tariffs. You're starting to see the CapEx really take hold, like people are making investments. Because of that, you're starting to see hiring plans really tick back up, which again kind of speaks to maybe this concern over the employment picture isn't as much as it should be. Is that fair?
Yeah, like when you want to study employment in the United States, you study small businesses and medium businesses. You don't study big businesses, because it is the small and medium-sized businesses that create, as we're going to show you here in a second, like preponderance of the jobs in the United States.
No, that makes all the sense, Scott. And as we start to think about, okay, who employs people across the economy, right? It's less than 20% of the S&P 500, even though that's all you hear about as you think about headlines, as you think about what you're reading. It's over 80% of the employment picture comes from small companies, medium companies, both publicly owned in that case, or publicly held, but then private companies or companies outside the S&P. That's where we're really, I won't say concerned, but we're really focused as we start to think about the employment picture. Scott, to your point, that's kind of what drives that employment market.
Yep, that's it.
All right, so let's shift gears a little bit and change over to fixed income, right? We've talked a lot about the economy broadly. Now let's shift into fixed income, interest rates. We'll talk a lot about the Fed here in just a second, but before we get there, Scott, we've heard a lot, and I'm sure everybody on this call has probably heard some version of private credit taking over. Is that going to be the next systemic problem? Like, what should we expect there? I think there's some pretty interesting data that would show you, yes, private credit growth has been, gangbusters over the last 10 years. but it's still a far ways away from kind of that systemic problem that we're concerned about.
Yeah, look, I mean, it's grown from an infant to a mini me. It is like it's. I'm not saying it's a zero importance, guys. I mean, like private credit is much larger now than it was a decade ago. I mean, you just see it on the graph on the left. I mean, it's grown like fourfold over the last 5-10 years. Like relative to everything else, is like grown some, but it kind of dwarfs everything else in terms of the growth rate. But we're talking about just like the size of the market, like that's the one on the right. I just want to again provide some perspective and some context for like what are we really talking about here? We're not talking about the mortgage market in 2007 2008. That that was that's a massive part of a not only Driven's books but sort of like just bank balance sheets overall. Like we're not talking. There's a lot of things we're not talking about. Like it's just like we're talking about private credit and what could happen in private credit. And could something could a hiccup in private credit take down the economy? Could a hiccup in private credit really impact markets? Like yeah, maybe a little bit, maybe for a short period of time. But we'd be pretty big buyers, like at least like here, we'd be pretty big buyers if we get meaningful stress out of like in equity markets based on a couple of private credit blowups, because these things tend to be more idiosyncratic, almost by definition. And it's just like you can just see how big they are. They're just not that big of the market. And so I just wanted to again let's kind of push pause on this a little bit. It's worth examining, worth paying attention to. But in terms of like being systemic, we ain't close.
No, I think that's a good point, and it is something that we want to make sure we hit on because, like I said, you're getting a lot of press, you're getting a lot of headlines around the private credit space. Not that it hasn't grown in a very meaningful fashion, but Scott, to your point, we think there's still a lot. There are much bigger areas of the market to be concerned about in that scenario. All right, so shifting gears a little bit, we have talked, and Scott, you kind of referenced it earlier. Right now, you're seeing a lot of that AI CapEx build out coming from free cash flow, right? One thing though that you're starting to see, and this looks at investment grade tech credit spreads, right? Just so like, hey, what are folks doing, and how are they pricing in the market this concept or this idea of debt funding when it comes to this build out? And you're starting to see, you can see it on the far right hand side, this concept or this idea that maybe those companies will need to start to rely on debt a little bit as opposed to just relying on the cash that they have on their balance sheet or the cash that they're generating. So Scott, as we think about this, why is that important? Why is that something that not necessarily we should be concerned about, but we at least should be monitoring?
Well, I mean, like we have to monitor because the market's pricing it, right? I mean, so we did talk a lot about the the capex build being funded by cash flow thus far. This is a sign that the market is starting to sniff out. Like maybe that's not going to be the case forever. It's still got some runway, guys. I mean, like don't get me wrong. Like this can be funded from cash flow for another year or two probably. But like if it continues on at this pace for a long time, these large tech companies that were very acyclical, very cash heavy, very kind of safe, kind of safe investments because they had both growth and good and bad times, and they had pristine balance sheets. Like the market's starting to show here that they're going to be more like a regular company, more like a regular investment grade company, rather than the sort of the low risk credit that they've been for most of the for really about as long as time is like outside of the internet bubble. And so like just the fact that the tech credit spreads are basically on par or slightly north of overall investment grade credit spreads is a clear sign that the market is starting to pay attention to this idea that like we might have to start taking on some debt. We think that's a little ways out, but this is the kind of thing that's on our radar.
And again, it's not catastrophic by any stretch, but it is, to your point, different than anything that we've seen in the last 10, 15 years.
Yep.
All right, so let's go back to kind of the Fed, right? We're going to talk about interest rates. We're going to talk about fixed income broadly. We have to start with the Fed, and I think one thing that's super interesting is we've talked a lot about this productivity piece. Scott, explain to us what we're looking at here, one, but two, like what does productivity do for the Fed as that gets input into their models?
Yeah, I thought about just having a page of Greek letters and Fervus models and that kind of thing. Like that would be a lot of fun for a webinar. Look, the reason I put this particular chart up here for this page was to just highlight the mid to late 90s when Greenspan kind of coined the term as a conundrum. Like they didn't understand really sort of the inflation dynamics. They had booming growth in the mid to late 90s and falling inflation, and those two things in the Fed model framework should not be able to coexist for very long, and they coexisted for dang near 5 years. And that caused basically just a lot of consternation. And look, the upshot for the math geeks in the world is that productivity is a supply side thing, and that only enters in the Furber's models and the Fed's models, the math models, basically in the long term. And so think of it as like it can impact things, it can impact policy decisions like a very long term, but it really has no impact at all on what the Fed, on basically what the reaction function should be for the Fed in terms of the math. So it's like the productivity changes don't impact what the Fed thinks Fed funds should be, like really. And it can impact sort of long run stuff, but it's really slow moving. And so the point here is like if we are getting another one of these like sort of productivity booms that is deflationary, disinflationary, just like it was in the mid to late 90s, we're likely to get confused math models again by the Fed because these are the same basic types of models that we had 25 years ago. They're the same basic sort of premises. And so that is a reason on the next slide where we got like all this confusion about like what should the long-term neutral be? Like where should basically, just think about neutral as like where should the Fed stop? Where how many more cuts till they stop to they're at their sort of the resting place? We think maybe it's one more, maybe it's two. It's somewhere in that 1 to 2 range. Like right now. But this chart is showing like the Fed themselves don't have a dang clue. Like they don't. I mean, there's like nobody agrees on where this neutral rate should be. And usually at the Fed, which is a government bureaucratic institution and an academic one at that, think about the conformity, like the power of conformity, the power to want to conform in a system like that is very high. There's a very high premium on conforming. If you're at a both bureaucratic and governmental institution and an academic one, which is the Fed sort of wears both those hats. Like that's like a double shot of conformity, and which have this amount of disagreement. And where like one of the most important things they calculate, which is where is neutral, is really sort of astounding. But it's coming from the fact that their models are confused by the disinflationary impacts of something like a productivity change that's generated by AI. Like we saw this in the 90s. We're seeing it again right now. We think that we're going to get a Fed that's going to have 1 or 2 more cuts and it'll be done. But there is a lot of sort of like noise around that number.
Yeah, no, Scott, I mean, I think that's super important to at least understand kind of that confusion. But I think what's also interesting, right, is if you actually look at what the market's telling us, if you look at kind of different ways to measure where the market thinks rates should be or whether there should be further cuts, I think what you're seeing and basically you're seeing these two rates converge to zero, or the spread between them converge to zero, which would suggest that the market's telling the Fed, hey, we think you should be done. I think, interestingly enough, and the picture of Trump here on the right, we'll talk a little bit about that and the concept of him telling the Fed to be done or not to be done. But I think what's super interesting is the market's essentially saying, hey, I hear that you're confused, but you should be done cutting. Is that generally what we're looking at here?
Yeah, look a little bit. I mean, like the title of the title on this chart. I apologize. Like we probably don't understand any of the individual words in that title. It's like kind of a confusing title. Like at the end of the day, like all we're looking at here is the black line is where Fed funds is, and the yellow line is where people think the market thinks neutral is, and like where are they going to stop? And right now that you're seeing that basically the market's saying, hey, listen, there's 25 basis point difference between where they are right now and where they're ultimately going to stop. And that is like that seems about right. So that means that they're about done. If I had more of these types of charts, I'd put reality show TV star Balin on here saying you're done. But I don't have enough time for that in this presentation.
All right, so Scott, if we are done, then I think you start to get a market, and we talked a little bit about this uncertainty concept earlier. You start to get that uncertainty removed from the marketplace, and you're seeing that as you start to look at interest rate volatility.
Yeah, and this to us is a pretty big deal. I mean, I talked for a long time, a couple of years ago, about like you're not going to get back to sort of a normal market until you get basically the Fed priced out of this, priced out of the world, and you can see that you can measure it by how much how nervous is the market about Fed policy by looking at how much it costs, but basically like what's the price of an option on a 2-year interest rate, and the price of an option on a 2-year interest rate right now is kind of getting back to these places of 14, 15, 16, 17, where the Fed was basically out of play. Like they were essentially out of play for much of this time, and so 4 basis points a day kind of price of the option is a pretty normal, like, hey, like the Fed's about done, we're not too worried about them. Maybe there's one or two, but maybe there's zero. But like the sort of the breadth of outcomes for possible Fed policy right now is, this chart is telling you it is vastly narrowed versus the last 2 or 3 years. And that vastly narrowedness, as he's pointed out properly, Austin, is, you can just couch it as an increase of certainty or a decrease of uncertainty. That is a helpful thing for financial markets, as we all know.
I think one thing, Scott, and we want to make sure we highlighted this here because we've had a lot of folks ask the question, right? Rates are being cut. Why haven't we seen kind of that bond reaction that's opposite of the bond reaction we saw in 2022, for example, right? I think what's interesting, right, is Fed funds have actually come down from 5.25, 5.5, all the way to below 4 over the last 18 months at this point. And the 10-year rate has actually gone up. And I think, Scott, that we need to remind people that Fed funds and a 10-year rate are very different instruments and very different time periods. And you're seeing that play out in real time, which I think has confused a lot of people in the sense that, hey, rates are going lower. Why hasn't the 10-year budged? I think you're seeing some of that disconnect start to play out, and folks are actually seeing the effects of it, right?
Yeah, and look, it's like this is actually a fairly normal type of reaction. I mean, when you have the Fed cutting like not into a recession, not into a like when the Fed cuts into a recession like 07 or something or 01, that's a different type of dynamic. And then all rates coming down because sort of the world's about to end, right? This is not that. We've said we've been very vocal about our no recession call here for the last 3 years. And we continue on that to ride that horse. But this is the kind of reaction you expect on longer term rates if the Fed is cutting into sort of a benign environment, into an environment where the cutting is going to spur future growth. And so if you're going to get the future higher nominal GDP growth, you'd expect slightly higher longer term rates with rather stable inflation, and that's exactly what you're getting. This is the bond market telling you that we're going to get a little bit better nominal GDP growth with stable inflation. That's what this picture says at the end of the day.
Yep. No, it makes all the sense. So, Scott, we alluded to it earlier, but I do feel like we need to touch on it, right? So the market is essentially saying, hey, you've got maybe one more cut in this cutting cycle, but we've all heard it, right? President Trump has come out and been very adamant that he wants lower rates. I think there's been questions of whether or not the Fed will really start to kind of, I guess, feel that pressure and continue to cut. That goes into a lot of the conversation around the next Fed chair, right? We can talk a little bit about that. But Scott, help us kind of unpack this really long title, but I think it does a really good job of highlighting that if we really want lower rates, Trump pressuring the Fed to cut is probably the last thing he wants to do.
It's just counterproductive. I mean, look, if the thing that he wants is lower mortgage rates and lower financing rates and lower long-term rates, which is what a real estate guy kind of tends to care about, the literal last thing he should be doing is talking about the Fed, because we've got examples in history that we're showing a few here. Like when the market determines that a central bank is captured, or when a central bank does not have independence, or when a central bank doesn't have inflation as a sort of number one priority, guess what happens? Inflationary expectations go through the roof. Guess what happens when inflation expectations go through the roof? What happens to longer term rates? They go through the roof. What happens to currency values? They go in the tank. And so if you want a weaker currency and higher long term rates, then you bully the Fed. It's fully counterproductive for what he's trying to do. So this to me, frankly, is the biggest risk. The biggest risk for 2026, that I today see is Trump becoming really bellicose towards the Fed, whoever is leading it, and the market deciding yeah, maybe this guy's gonna win. Maybe they're gonna do do the turkey thing and just cut rates like crazy because he's pressuring them. If that happens, guys, we're gonna end up with much higher longer term rates and much lower dollar value than otherwise we would. And so the good news is Bessent certainly knows this. The guy's a pro. He's been around global markets for a long time. I'm sure he's advising President Trump on something like this. But I just want to state the absolute last thing he should be doing if Trump wants lower long-term rates is talking about the Fed, right, and really trying to bully them. It's just fully counterproductive.
No, makes sense. All right, last slide on the fixed income side of things. And Scott, we've talked a lot over the last couple of years about how rates and inflation are tied together. I think what you see now, and we've talked about it for a while, is this idea of inflation expectations are coming down. You can really start to see kind of this idea of inflation expectations anchored kind of near or at that long-term target that the Fed's shooting for. Scott, maybe talk us through this chart, but also talk through, we've talked for a while, this concept of tariffs not necessarily being inflationary, but being more deflationary or disinflationary. You're actually starting to see that play out if this chart tells us what I think.
Yeah, you are. And all you have to do is like look at the reaction of the different sort of time periods around Liberation Day, around March. Like you had like 1 year inflation spike, but you had like 2 and 3 year inflation a year or two out actually go down at the same time because I mean there's the very short term obvious kind of stupid impact for tariffs is it makes prices higher. The longer term impact is a tax. Taxes are deflationary because taxes like they're destroyers of demand. And like all the things we talked about in the past. But at the end of the day, this is super helpful to see right now is all three of these kind of years converging. So you're seeing that like inflation expectations for this year and expectations for the next year and the year after that, they're all basically the same. That is a stable inflationary, basically a stable expectation environment for inflation. That is anchored. That is super helpful. That's what the Fed wants to see. Like they're doing a good job.
Awesome. All right. So we've hit on the economy broadly, right? We've touched on labor markets. We now talked about fixed income and interest rates. Scott, let's hit on equities as kind of the last piece here. And again, we've given a lot of things to maybe be optimistic about. I think one thing, just from a history standpoint, is if you look at the presidential cycle, right? Historically, the second year of a presidential cycle has been the one that has been kind of the most challenged, right? You're heading into a midterm election year, right? You're having conversations around a bunch of different, probably hot button topics, probably creating uncertainty from a headline standpoint. You can see it. We've boxed it in here. Year number 2 historically has been the worst of the 4. Now, that doesn't necessarily mean that 2025 lines up, or sorry, 2026 lines up to be a terrible year just because of that. But that is something that we're keeping an eye on and paying attention to. And Scott, I do think there's some uncertainty as we start to talk about some of the midterms and some of the political kind of hot button topics that will come up over the next 6, 9, 12 months that probably we're not even thinking about right now.
Yeah, sure. I mean, it'll be the case that there's something that we don't know about today that will impact markets this year. And midterm years can be more volatile, can be a little choppier, a little bit nastier. We don't think it's going to really drive the bus, but we do want to at least state out there's the political sort of background is probably a slight headwind as for the year.
Yep. On the flip side, though, Scott, and we talked a little bit about the Fed kind of being done and kind of being, in this case, boring. Like a boring Fed's a good Fed, right?
Boring Fed's a great Fed. We love a boring Fed here at Horizon Investments. Look, it is boring Fed. Like you just see from the chart, like this is basically market equity market SP 500 returns under different sort of rate cutting and rate hiking regimes for the Fed. Like how much is the Fed at the extremes you see like when the Fed's either cutting a ton or hiking a ton, the market hates it. When the Fed is doing very little, the market loves it. We are in the realm of the market the Fed doing very little. So a boring Fed is a great Fed. That's what we're cheering for.
Awesome. All right. So we've talked about this, I feel like ad nauseum, but we wanted to show it at least one more time. It's this idea that, right, we've talked a lot about kind of the profitability side of things. And right, we're not seeing a mid 90s, late 90s bump in the market that's not supported by profits. You're actually seeing the opposite. You're seeing profitability reaching all-time highs, growing at consistent rates that we really haven't seen in some time. And that's part of the reason the market has done what it's done over the last little bit, is it's really keeping up with kind of those fundamentals that are driving the market at its core. Again, very different than what we saw in the late 90s, early 2000s. And we want to make sure to highlight that because what you're looking at, Scott, is like we have a really strong picture when it comes to earnings growth, when it comes to revenue growth, earnings growth on the left, revenue growth on the right, expectations for as we look out into 2026, expectations if we're looking at kind of the fourth quarter of 2025, like consensus numbers are really continue to be better than anything that we've seen just even more recently.
Yeah, like I mean, top line growth of 8%, bottom line growth of 15%, or somewhere in the mid-teens. really healthy. That is, if you just do the simple stupid math, like, if you have no move in PEs, that's a that's a teens type of return for at least the S&P 500 in 2026. If those estimates are right. I mean, like, the big caveat, the estimates have to be right, obviously. But it is setting up for a reasonable year, and this year with a couple of different tailwinds.
So Scott, if we take earnings growth and we take revenue growth, how do we translate that into kind of what that means for the individual companies and what that means for maybe from a market standpoint?
Yeah, it means margin expansion. So whenever you're getting earnings growth, or like at a higher clip than revenue growth, at the end of the day, you're talking about margin expansion, and you would expect to see margin expansion if you have productivity gains, and this is like one of the most important channels that you can get in equity pricing. If you have an increase in margin, that has an exponential impact on stock prices. If you have just earnings growth, that's a kind of a linear impact on stock prices. And so the most powerful thing you can get in equity markets is margin expansion. And we are starting, we have seen that. We're continuing to see that. Margins, at least on the S&P 500, are basically at all-time highs right now. We expect them to grind higher as the AI sort of technology and productivity gains like diffuse again throughout the economy. As companies figure out how to use this stuff to make themselves more efficient, that should be a driver higher of margins. That is a really important tailwind for stocks for the next couple of years.
Well, and Scott, I think it does a pretty good job also of explaining what we've seen over the last couple of years as we look at the technology sector, as we start to look at some of those telecom companies as well. Like, what you're talking about is those are the companies that have seen that margin expansion. They're the ones that have seen earnings really take off, and the market has rewarded that, right? So like, you've seen that play out over the last few years. I think what we're talking about now is, do you start to see a market that broadens that out? Not necessarily that technology companies fall off a cliff. It's maybe just that the rest of the S&P 500 or the mid caps and the small caps start to catch up from an earnings growth standpoint. And if that's the case, then really you get that movement, broader market that we're talking about.
Yeah, look, I mean, the market has followed fundamentals. Like, the returns have gone to those that have grown earnings the fastest and the best. That doesn't always mean it's going to be forever, ever, amen that way, though.
So, Scott, we touch on kind of the top of the market, right? We call it the Mag 7. You can pick your name for it. Like, we all saw it, right? Time, Person of the Year, Architects of AI. Like, there's a lot of that top of the market that's covered in that picture. If that's the case, are we going to get a cover jinx that we should expect heading into 2026?
I mean, look, it is setting up this way. Yeah, we'll see. I mean, this is a pretty standard sort of knowledge base. Like when things do really, really well, you get popular press coverage, and it's sort of the shoe shine boy kind of argument. Like, when shoe shine boy is giving you tips, it's probably time to get out. Like this is just like it's the popular press is coming into sort of the mainstream, and once it gets there, the investment team may be sort of closer to the end than the beginning. And again, but I think it's important to stay, Austin. Like, you don't have to have these stocks go in the tank. These stocks are still incredible earners. They're still like growing revenue and EPS and margins and like incredible clips. They are the most powerful companies in the world. They have the most cash on hand to basically be the employers of AI. So there's a lot of good that's backing these guys right now. So it's not a place where I'm saying get short all these names because they're going to zero. And this is just a place where there is space for the rest of the market to start playing a little bit of catch up here. And and these guys can have these stocks can have basically a correction in time rather than a correction in price. Yeah. And we think that's probably the more likely outcome for 2026.
Well, and Scott, you started to see that play out really in the last quarter of 2025, where if you look at think of it as AI winners or AI leaders relative to traditional cyclical companies, right? In this chart, the orange line going up and to the right would tell you that AI winners are leading cyclicals. You started to see in the fourth quarter kind of that broadening out trade where cyclicals actually finally led in a meaningful way some of those AI winners and really leading the market higher, which, as you can tell from this chart, we haven't seen for any prolonged period of time in a number of years. So, Scott, I think that's what you're referring to, is this concept of, hey, if we start to see that broadening out, if those cyclical companies really start to be the leaders of the market, doesn't necessarily mean that those AI companies, those technology companies, have to just completely fall apart, but maybe it means that you see that market more broadly defined, from a leadership standpoint, really start to carry the day.
Yeah, I mean, like we think this is a kind of a coiled spring for the cyclical side of the market as we come into 26. I mean, like to get cyclicals to really work, you need a couple of things. You need one them to have sort of their businesses in a place where they can take advantage of they basically have taken the time to restructure themselves, get themselves efficient, cut all the fat, do all the things they need to do to get the business running. But then like when as you come into a year like in 26 that we're coming into with a lot of fiscal stimulus and a lot of stimulus in the pipeline essentially. Both from a tax standpoint, a policy standpoint, and from essentially what we're calling private, private stimulus, which is the capex stuff. That's a lot of tailwind for nominal GDP growth. And if you have a combination of companies that have taken a couple of years to kind of get their operations and like their ducks in a row, and you get a nominal GDP boost or boom from several sources simultaneously of sort of stimulus. Man, you get a nominal GDP boost out of that. Like you got companies that are just coiled to go, and we think that's actually probably what's started to happen.
Yeah. Well, and if you talk about kind of that coiled spring, Scott, I think another area that we think also maybe has a tailwind coming into 2026 is small caps, right? And part of that comes from the fact that rate cuts maybe finally start to help those smaller companies.
Like it takes time. It takes time for rate cuts to really kind of work their way into the economy, work their way into helping. Small caps are obviously more cyclical than large cap index at least is. And so what we're starting to see is like small caps basically small cap EPS went nowhere. You went nowhere from basically the end of 22 until very basically this quarter or last quarter. And all the while like large cap EPS kind of continue up and to the right. And so this is basically the reason why basically large cap beat small cap for the last 3 years. It's just really kind of as simple, stupid as that. But look at the inflection. Look at what's starting to happen with small cap EPS. They're starting to finally kind of start to inflect higher, and it's partly because it is we're basically in the 12-month post Fed cutting cycle period where those cuts have kind of they've had the gestation period time enough to like get into the system and start to impact the economy. These things always operate with lags. Like cuts and hikes always operate with lags in the real economy and like not necessarily in financial markets, but in the real economy they do. And the real economy, like it's not a secret that like or not not a mystery that 12 to 18 months post the cuttings is when it really starts to impact the economy. Like that's what we're seeing. We're starting to see it in the evidence of small cap earnings. And it's just like this is just another example of kind of the things that we think could be an interesting way to play this market in 2026. That broadening out theme that people have been talking about for a couple of years. Like everybody wants the market to be broader. They're like it's too top heavy. Blah 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 blah. It's been top heavy for reasons because that's where the earnings growth has been. If the earnings growth starts to broaden, then the market can start to broaden. That is the basic takeaway from a slide like this.
Well, and Scott, another thing I think on this slide that we want to make sure to highlight that you can see it. We're not suggesting large cap earnings are going to roll over, right? They can still be growing. It's just you may see the small cap growth rate pick up from where it has been, which, as you alluded to, has been flat to zero for the last 2 years.
It's been abysmal,
right? So if you finally get that from the small caps, maybe that's what we're talking about here.
That's right.
Okay, awesome. Well. Really appreciate, Scott, you taking the time. Again, takeaways here. We touched on the economy. We touched on labor markets. We touched on fixed income, equities. Have had a couple questions come through. If we haven't gotten a chance to answer your question, and we're gonna hit a couple of them here at the end, but please don't hesitate to reach out to your regional director, to your strategist, to our internal desk. Would love to answer those questions that you have and continue the conversation. But Scott, one that has come across is if we look at 2025, international stocks, both developed and emerging, probably had their best year in quite some time, both absolute and relative to the U.S. Is that what we should expect heading into 2026 for internationals to lead again in such a meaningful way? Or is there something that maybe leads the U.S. back into that top spot?
So it's much more nuanced question this year than it was last year. I mean, look at the end of the day, you're talking about a currency play. You got to get the currency part right to get the international part right. And if we think rates are about where they should be, both here and abroad in general, it's we don't see big movements in currency this year. I mean, the first quarter last year saw a massive dollar sell off, and that essentially was the year. for the international U.S. Equity spread. It was basically all in that first quarter when the U.S. dollar got pummeled. And basically sort of treaded water there like the rest of the year. Like we kind of see more of a tread water type of environment. So we tend to favor right now, more of the Asia, more of the emergings than we do something like Europe. But like we see value in some of the international space, but we don't think it's going to be quite as sort of quite as broad based and quite as sort of easy as it was in the first quarter last year.
No, makes a ton of sense. So, no, Scott, really appreciate the time. And like I said, really appreciate you all tuning in and spending time with us today. Would love to continue that conversation. Please don't hesitate to reach out. I'd also encourage you to head to our dashboard online. If you haven't been there, there's a lot of great information there. We've got some new tools that we are continuing to roll out and continuing to enhance. So encourage you to go there. But again, love to continue that conversation, whether it's in person here in the office, like I said earlier, or over the phone, or maybe we're in your office, hopefully sometime here soon. So hope everybody has an awesome start to 2026, and really appreciate you spending time with us today. Thanks so much.